Hello, class. This is a lecture for Chapter 2, Analyzing Transactions. Again, this is financial accounting. So the learning objectives for this lesson is going to be describing the characteristics of an account and a chart of accounts, describe and illustrate journalizing transactions using double entry accounting system, describe and illustrate the journalizing and posting of transactions to accounts, prepare an unadjusted trial balance and explain how it can be used to discover errors, and finally describe and illustrate the use of horizontal analysis in evaluating a company's performance and financial condition. So these are the guiding objectives. Using accounts to record transactions. Accounting systems are designed to show the increases and decreases in each accounting equation element as a separate record. So this record is called an account. So this is an example. Whenever you look at it, I did do a video that I sent to the entire class where I went through and look at the assets equal liabilities plus owner's equity or stockholders' equity and what happens with each account. We talked about double entry accounting. So there's an entry here and an entry here. So that's the double entry, and we'll go through and take a look at that more detailed today. So T accounts. Each account has a T account as a title, which is the name of the account equation element recorded in the account. So each equation, each asset, each liability, each stakeholder's equity, each revenue, each expense will have its own T account. The left side is called a debit and the right side is called a credit. Now, whenever you take a look at it, remember, always remember DC. I always thought ACDC, like the band, DC, debit comes first and then debit's on the left, credit's on the right. So this is a cash account. So our first entry was for $25,000. The second entry was for $20,000. The third adjustment. So that if it's a credit, that means it's being taken away. If it's a debit, it's being added. So on the right side, 20,000 was taken out, 3,650 was taken out, 950 was taken out, and 2,000 was taken out. On the right, there were two entries that were made, and that was for 25,000 and 7,500. So the balance in this account will be 5,900. If there's a negative balance, which typically you won't have a negative balance in the cash account, you'd have to find cash from somewhere. So that's the T account for cash. Now, chart of accounts. They're a group of accounts for a business. Is called a ledger. A list of accounts of the ledgers is called a chart of accounts. Accounts are normally listed in order in which they appear in the financial statements. Balance sheet accounts are listed first in the order of assets, liabilities, and stockholders' equity. You'll have to excuse me, I'm getting over a cold. The income statement accounts are then listed in the order of revenues and expenses. Assets, these are some examples: cash, supplies, intangible assets, patents, copyrights, trademarks. Accounts receivable, prepaid expenses, buildings, and equipment. Liabilities are debts owed to outsiders. Excuse me, creditors. These are examples: are accounts payable, notes payable, wages payable. Now, wages payable is where you put it in to a creditor, and you put it in a credit account. For example, if you go to Wells Fargo to use a line of credit to pay your creditors, which that's not recommended to do. Unearned revenues, cash received from customers before services are delivered. So unearned revenues, let's say you have a George Strait concert in Winter Rock during the Navajo Nation Fair, and you start collecting money before the event actually happens. That goes under unearned revenue. So that's what unearned revenue is. Stockholders' equity, that's pretty common. There's common stock, there's retained earnings, there's dividends as well. There's several different types of stakeholders' equity. There's preferred stock, and We won't get into that in detail. If you take advanced accounting, you'll probably get into that. Revenues, increases in asset and stockholders' equity as a result of selling services or products to customers. Examples of revenues are fees earned, fares earned, commission revenue, rent revenue, interest revenue. There's a bunch of different type of ways to earn revenue. Let me think of some other sales revenue, things like that. Expenses result from using any asset or consuming. Example, wages expense, rent expense, utilities expense, supplies expense, miscellaneous expense. There's phone expense. I guess phone would fall under utilities, but there's all sorts of expenses. I can't remember if we get into cost of goods sold, but that's also an expense, but we'll get into that. I think that's the second half of this book. I think that's accounting 201, I believe. In some schools it's accounting 202. Accounting number system. Accounts are grouped by account type, assets, liabilities, stockholders, equity, revenue, expenses. Each type of account is numbered using the same digit. For example, assets begin with 1. I've seen them 100. I think when you have a lot of accounts, I've seen them as 1,000. Liabilities begin with a 2, equities a 3, revenues begin with a 4, expenses 5, and so on and so forth. Again, just depends. They start with a 1 all the way through 5. Chart of accounts for net solutions. So on the balance sheet, assets 11, 12 accounts receivable, 14, so on, as it's listed right there. I won't go through all of them. Liabilities, remember I said 2, 2, 1, 2, 3. Stockholders, equity 3, 1, 3, 2, 3, 3. So dividends are whenever you pay. Let's say you can give a dividend whenever the company does well. Like each year, if Navajo, the Nappy up on the farm, up on the hill, the Navajo large farm. They usually, if the company does well, they'll do a dividend at the end of the year. So just an example. Income statement accounts. Those are all 4s and 5s, and it's expenses minus revenues minus expenses. So those are the example of the numbers for the revenues and expenses. So double entry accounting system, all businesses use double entry accounting. It's based on the accounting equation. Every business transaction recorded in at least 2 accounts. The reason why it's accounted for twice is there's always the checks and balances in accounting. If your equation doesn't balance, you did something wrong. You always have to go back and double check. So debits recorded for each transaction to be equal to the total number of credits. The system has specific rules of debit and credit for recording transactions, and a lot of these are linked to GAAP or GASB. So balance sheet accounts. The debit and credit rule for balance sheet accounts are as follows. Debit's always, not always, for assets a debit is an increase, a credit is a decrease. On your liability side, a debit is a decrease and a credit is an increase. Stockholders' equity, debit decreases and a credit increases. Now, on the income statement, these are sometimes referred to as contra assets, or not contra assets. These are all referred to as contra accounts. Okay, the rules for them: revenue. If you gain revenue, it's a debit for a decrease. Increases for credit. On the expense side, debit increases and a credit decreases. And those are specific to income statement. There's also contrasts, like I mentioned, but I won't get into this. Depreciation, accumulated depreciation is actually a contra asset because it decreases, and I'll show you that later. Dividends, debit for increase, credit for a decrease. Okay. Normal balances, the sum of increases in an account usually equal to or greater than the sum of the decreases in the account. Thus, the normal balance of an account is either a debit or credit, depending on whether increases in the account are recorded as debits or credits. Rules for debits and credit normal balance sheet. So this is what happened. This is a big view of what this looks like, and this is very similar to what's in your textbook or your online if you get the ebook. So it just goes through all of these things. And notice right here it says your dividends go out into retained earnings, or your your income statement goes into your retained earnings, and it all closes out. If you watch my video, your income statement closes out into your statement of owner's equity, or stockholders' equity, and then that equity, stockholders' equity ends up going on the balance sheet. So it's a really nice system. I mean, I like systems, and that's, if you're really good at understanding systems, accounting's a path for you. Check up corner balance sheets. We won't get into this. This is just an example. Let's see. Journalizing. Using the rule of debit and credit, transactions are initially entered in a record called a journal. Okay, so journalizing, transactions are recorded in a journal using the following steps. First one, date the transaction is entered, okay, in the column. Title of the account to be debited is recorded to the left of the description column, and the amount to be debited is entered in the debit column. The title of the account to be credited is listed below and is indented. I usually say 3 to 5 spaces to be debited to the debited account title, and the amount to be credited is entered in a column. I know these are all words, but there'll be an example here in a bit, and it'll explain what that means. 4, brief description may be entered below the credited amount. The posting reference column is left blank when the journal entry is initially recorded. This column is used later when the journal entry amounts are transferred to the accounts in the ledger. So all this will be explained. I know some of you, like me, when I read stuff, it doesn't make sense. I have to see it, so I'm pretty visual. The process of recording a transaction in the journal is called journalizing. The entry in the journal is called a journal entry. The form of journal illustrated in transaction A is called 2-column journal. So here's what this looks like. Here's what I was talking about. So as you can tell right now, 25,000, as it said, the date, November 1, that's your step 1. Your step 2 is putting it in as your descriptor column, cash, and then you debit in the debit column for 25,000. Step 3, you put 25,000. Don't forget, they always have to, when there's a debit, there's always a credit. So step 3 right there, so it's 25,000. And then also in step 3, you put your common stock, because you're putting equity into your common stock. And then your step 4 is right below your second credit entry. You put in there issued common stock for cash. Step 5, post-referencing, that's done at the end. Sometimes your post-reference, I've seen the post-reference come after the date. So this book is a little bit different. So it just depends. And then at the bottom, so then the double entry accounting, down below it says assets equal liabilities plus stakeholders equity. So the debit goes on the debit goes in cash for 25 and common stock, a credit November 1 for 25,000. Okay, so that's an example. So transaction terminology and related journal entry accounts. So receive cash for services, cash, debit, fees earned is a credit. So those are some examples. I won't go through all of them. It's kind of, to me, it's best to actually record them and understand where they go. But you can look at those as an example. It is in the textbook, or it's also on the online Cengage. So transaction B, 20,000 for the purchase of land. So land is going to be, obviously put the date November 5th first. Land debited for 20,000, and then per cash, since 20,000 came out of our cash account, so we're going to credit cash for 20,000. Purchase land for building site. Okay, so on the bottom left, let's see. So our increase in land went up, but our decrease in cash went down, and that's what is noted right there. Okay. C, let's see, November 10th, purchase supplies on account for $13.50. Date was November 10th. Supplies is going to increase by $13.50, so that was a debit. We put this to account payable, so our account payable is going to be credited. So on the right side of the equation is actually increasing. So purchase supplies on account, that's the actual note that you're saying, so that you understand what's going on. Okay, the D transaction solution received cash of $7,500 from a customer for services provided. So this indicates we got cash, we received cash. So November 18 cash is going to be debited for $7,500, fees earned. So we're realizing actual revenue now because it says fees earned for $7,500. That's going to be a credit, but over on the right side that's how we have to enter it. But you'll see as in the larger picture. And then note it, receive fees from customer. Okay. Transaction E, incurred the following expenses: wages $2,125, rent $800, utilities $450, and miscellaneous for expenses for $275. So on your expenses, it's gonna, all you're doing is accumulating expenses in these particular accounts. November 30th, this all happened on the same day, and you paid cash of $36.50. And don't forget, those always have to equal that 21, 25, 800, 450, and 275 have to equal that 36.50. If not, there's something wrong. So then right below it, you said pay expenses. So I'm assuming you paid all your bills in one day. That's why they're all listed together. Okay. And then over on the bottom, it just shows the accounting equation and its impact. Transaction F again. Net Solutions paid creditors on account for $950. Account payable. So our account payable is going to go down for $950. Our cash also went down. So if it's a credit in our cash, that means we paid cash out of our cash account, paid creditors on account. So in our account payable account should decrease as well. Transaction G, we purchased $13.50 of supplies in November, on November 10th. Chris Clark determined that the cost of supplies on hand on November 30th was $550. Thus, $800, $13.50 minus $550 of supplies must have been used during November. So what we're doing is we figured out, we did inventory on our supplies, and so $800 was expense. So a plus supplies expense for $800, and then supplies for $800. The reason why it's credited is we're taking out $800 out of our supplies T account. So supplies used during November. Transaction X, Net Solutions paid dividends of $2,000. So dividends is going to be coming out on November 30th. Is going to be a debit, and then cash on the right side, because we're taking cash and paying it to the owner of the company, and it says paid dividends for $2,000. And then what happened to the account is on the bottom, or what happened to the T accounts is on bottom, and on basic, which is the accounting equation and how it's impacted. So okay, we'll go past this. This is just another example. So checkup. Okay, you can look at this a little bit more detail. This is just following up. Post journal entries to accounts. The process of transferring debits and credits from the journal entries to the accounts is called posting. So we're posting to the journal. We're posting journal entries is what's going on. So again, paid a premium of $2,400 for an insurance policy. So this will be a prepaid account. So prepaid insurance, $2,400, cash $2,400. So notice it says 15 and 11. So we put prepaid insurance. Those we're talking about where these entries are going. We're telling them it's going to it's going to account 15 and account 11. Okay. So the T account has been replaced by a standard 4-column account in the next slide, in addition to debit credit columns for recording transaction. The standard account form also has balance, debit, and credit columns. These balance columns are used to indicate the account balance after each transaction, sometimes called a running balance. Okay, so this is posting journal entries to accounts. Excuse me. So then prepaid insurance, again, step 1 is going to be, oh my gosh, where is that? December 1, debited $2,400. That's also going to go, that's going to come up from the actual journal, and this is going to go into the account called prepaid insurance. Step 2 is $2,400 credit. That's going to go on to a running balance in the cash account of $2,400 December one as well. Okay. Now, step 3, you're going to put posting reference, and you're going to say it's going to go to 2. Well, and also 2 up as well. In the account right here, it says you're putting 2 as a posting reference because you're referring to the page number right here, page 2. So 2, 2, and this is where it was recorded on the journal, was on page 2. So that's what the posting reference is about. Okay. On here, notice how your posting reference says 15. Well, it's referring to account number 15. Your posting reference for your cash is referring to your account number 11 right there. So just keep it's just a way of recording and checking and making sure you accounted for it. So posting journaling entries to accounts. The debits and credits for each journal entry are posted to the accounts in order in which they occur in the journal. The debit portion of the December 1 journal entry on the previous slide is posted to the prepaid account using the following 4 steps. Okay, we actually just talked about that, and I just explained that, so I won't go through that again. Again, I just went through this again, and I showed you because this is words. If you want to read it, that's fine, but you know, you can go through that. I like for it to be explained to me as opposed to reading it, because it kind of gets jumbled in my head. I have to visually see it. So transaction. I'm going to stop right here. I'm going to record these videos in 20-minute segments just because it takes like 2 hours to upload anything over 20 minutes. So I'll continue at the end of this in another video.